All right, so our first question via email came in from Len. And Len wanted to know how to calculate the probability of winning on credit spreads. He says, today on bull put credit spreads, selling an out-of-the-money put, buying a lower strike put, so you don't have the margin of a cash secured or naked put, but still have the potential for a good net credit. He's watching MU and looking at live data, and he saw matching MU probabilities. The equivalent spread was 70 to 68. 70 strike had about an 88% probability, 87.9% probability of expiring worthless. Now, this did change, and when I started to put the slides together at 2:30, it was actually the 73-71 strike that had the 86, 87, 88% probability at that time, but that's okay. What are we talking about here? The static probability shown on PowerOptions that you can filter on in any strategy is the probability of the stock remaining above, in this case, the sold put strike price at expiration. This is what we use to evaluate probabilities, and for this strategy and approach, it's been pretty much on the nose for about the past 5 or 6 years. We'll have some more comments on that in a little bit. The probability is really related to the delta in a sense. Similar calculations, similar factors, I should say, are used to calculate both the delta and the probability. We're talking about the static probability in this case. On PowerOptions, we show the probability above and probability below for every option. And as you can see here, looking at MU for December 17th expiration, the 65 strike put has an 85.3% probability above, meaning that there's a theoretical probability MU would stay above 65, 85.3% probability. Now the delta is a put, so it's showing as a negative delta, slightly out of the money, of about 0.14. So adding those two together, 14 delta to an 85% probability, we're almost at 100, right? They're very similar. An 85.3% probability above equates to a delta of around minus 0.15, 15, a little bit lower. Right at the money at the 70 strike, I'm sorry, this is Barry, my apologies. This is Barry at 69.85. The at the money strike has about a 50% probability. 48.8% of the stock would be trading above 70 on December 17th. Of course, the delta is pretty much at 0.5. It's at 0.499. So you see here they're very similar. And of course, we go higher up in strikes. The in the money 75 strike put, in this case, has a probability of 15% that the stock would be trading above that, or 85% probability that the stock will be below 75. And that pretty much directly equates to a delta of minus 0.842. So the reverse sort of what we're seeing here, 85% probability, 0.14 delta, 15% probability, 0.84, 0.85 delta as well. Okay. Occasionally you will see differences if you're using Thinkorswim. I chuckle on that, but I'll do that in a moment. You're looking at Thinkorswim. Maybe you're using Tastyworks. Maybe you're using Interactive Brokers. You're looking at the same option. I'm looking at the Barry 65 strike for December 17th as a potential put to sell with a 85% probability. And on Interactive Brokers, it might be 81.2. On Thinkorswim, it might be 78.4. The difference is based on the time frames that are used for the factors in the calculation. Past trading range, for example. What are we talking about there? What has the stock done in a past time frame? The probability equation is the same. I can almost guarantee the actual equation that's being used across all services is the same. And it's based on the past trading range of the stock. Based on what the stock has done, what is the likelihood that it will be above or below a certain strike price at expiration. Now, the numbers might be skewed if one service is using 20-day history, one's using 50-day, one's using 100-day, one's using 250. Those are the differences that you see. The equation is the same. It's just the choice based on the service. What time frame are they looking at for the volatility calculation or implied volatility calculation that's used in the probability equation? Okay. All right. And this leads to Len's main point of question number one. This is why I chuckled. He said, my Thinkorswim chain also showed a probability of touch of 23.21%. Now we saw that the probability above that short put strike price in his equation was 87.98%. 88% probability the stock would be above that 70 put strike on MU, and the bull put credit spread would expire worthless. But now he's seeing this probability of touch of 23.21. And he wanted to know, does that lower the win rate from 87.98 minus 23.21 to only a projected win rate of 64.7%? Well, what are we talking about here? The probability of touch, or what's sometimes called the ever probability, is a Monte Carlo type of probability equation. It's slightly different, and it looks like the likelihood that the stock, your underlying security, would ever come down and touch your short put strike price between now and the expiration date. It's kind of based on random sampling, random events, random occurrences of data points rather than a fixed time frame. My direct answer to his question via email, to Len's question via email, was regarding the probability. The ever probability or probability of touch is a different type of equation. It's not one we really use or studied or have tested when setting up our default searches and our tests for weekly naked put picks of the day, covered call picks of the day, the monthly naked put picks of the day, or our bull put credit spread, or bear call credit spread, or other strategies on PowerOptions. So in that sense, I can't really validate the benefits or the efficiency of that metric as it leads to credit spreads, debit spreads, other strategies. However, I do not think that we could say that this would lower the win rate down to 64.7%, just taking the original probability at expiration of 87.9 and subtracting it from the ever probability, or probability of touch, I should say, of 23.2. Because the ever probability, the probability of touch, is a different equation compared to the static probability at expiration. After I answered the email, he said he wanted to talk about this, and I said, okay, well, I'll think about it, but we've covered this before. But then I realized there were some better answers to his questions. So the better answer to his questions, that then lowered the win rate to 64.77% if I just subtract the ever probability from the static probability, has a higher value. And a better answer is no. In my opinion, a 23.21 probability of touch, ever probability, would more likely mean a 76.79% win rate. If you were going to close any trades of this style, bull put credit spread, if the underlying security moved down in price and hit the short put strike price during the time of the trade, which is a common way of doing it. Now, a common way of looking at it, probability of touch is commonly just around 2 times the probability of being in the money. Our put option on the MU trade, the 70 strike, had an 88% probability of expiring worthless, an 88% probability that MU would be above 70 on December 17th, which translates to roughly a 12% probability that the 70 strike would be in the money, that the stock would be below 70, only 12%. It's essentially around double. So probability of touch, 23, 24%, kind of double the probability of that put being in the money. And again, probability of touch, if you were looking to close the positions when they hit that strike price, I would say that relates more to a 76.7, 76.8% probability rather than the 64.7% line. Okay. Now, I keep using the terms theoretical, expected, likelihood. Probability is a theoretical equation based on the past trading range of the stock. Rather, I should say the volatility or the implied volatility. It cannot account for unexpected events, black swan events, poor news coming out, a CEO going on Twitter and saying the exact wrong thing at the wrong time and causing the stock to plummet. That's not in the norm of what the probability equation looks at. And again, the differences that you might see across the services are based on the time frame. It's the same equation. It's just a decision each service made. Are we going to use the 50? Are we going to use the 100-day volatility? They're probably using IV or SIV of the options, okay, which is generally what we use. But to get the IV or the SIV, you have to base it on the stock volatility, and are you basing the stock volatility on a 20-day volatility of the stock, a 50-day volatility of the stock? That's why you see subtle differences between services in those cases. All of this leads to Len's main question. We had that presentation on it last week. You saw the gold star on it when I showed the content that was recently posted. So Len then goes on to say, using the 1% rule, if I were to put a stop on the above spread, using the 1% rule, which is a preferred choice of ours as an alert, as a potential trigger to close or manage the position, would I trigger the stop when MU touched 70.70? Yes. Take our short put strike price here in the bull put of 70. If we sold the 70 and bought the 68, my 1% alert would be set at $70.70. Now, if that trigger's hit and I've decided to close the position, would you suggest the closing order be a market order or limit order based on mark plus limit? Okay. So we had this discussion I mentioned last week about the 1% rule and the 50% rule, 50% of the maximum loss for spread positions. Same applies to a bear call credit spread if the stock moves up within 1% of the sold call in the opposite credit spread position. But in the bull put here, the stock falls within 1% of the sold option. It's not always a hard stop for me, but it is a trigger to decide to close the position or maybe adjust the position using one of the preferred 8 ways to manage a bull put credit spread. My direct response via email to Len was, if the stock hits the 1% rule, I personally will be alerted by the PowerOptions portfolios. I'll manually go in and close the spread, and I will attempt to get filled at midpoint, especially if it's a sudden drop. The stock, I started out with a bull put spread that was 5 or 7% out of the money. The stock moved up 2 or 3%, and then today the stock fell 8%. And I'm in within my 1% rules, a sudden drop. What's going to happen? The implied volatility of the options on that stock are going to jump. I'm likely to see a wider bid-ask spread. I don't want to get out at the market order if possible. I want to get in or get out at the midpoint. I'm going to try to get the midpoint on that position. Now, of course, depending on why the stock fell to my 1%, I may not decide to close the position. I may decide to convert it to a bearish spread. I may decide to buy back just the short and leave the long open if I think it's going to fall further and I still have time on the trade. Those are some of the discussions on the 8 ways to manage a bull put credit spread. Okay? Now, of course, I must admit, I have the benefit and the luxury of being here online on PowerOptions the entire trading day. And not everyone has that luxury. I completely understand that. I am spoiled. I will admit that freely. I'm here, even if I'm on the phone. Hey, if I'm on a coaching session and one of my alerts is triggered, I've never stopped a coaching session to go handle a trade, honestly. I've had customers hear bells go off in the background and stop a coaching session to go adjust their trades, but I've never done it personally. I'll wait till the end. If I don't get the right fill price, I take maybe a 60 or 62% loss instead of a 50% loss. I'll accept that. That's fine. I don't like to, but hey, customers are sometimes more important in that case. If you are unable to actively trade during the day, which I think is Len's issue, he's not watching his computer screens all day, and the 1% trigger is hit, if you're using that as a hard stop at your broker, I feel you would still try to get filled at the midpoint if possible. Mike, you said you might try to use the market plus, the mark plus the limit or something along those lines. I prefer to use a limit order if I could, though I'm not going to know the exact prices depending on how the IV fluctuated. If this just happens suddenly during the trading day, market ends on a bad note, the Fed chair says something and it causes that last hour of trading to decline and I hit my 1% and I'm already out for the day, something along those lines. I'd prefer to use a limit order rather than a market order, because my fear is if it is a sudden event where you were looking good, now all of a sudden you're at the 1% stop in that position, IVs may have increased, wider bid-ask spread. I put in a market order, I'm going to get the worst possible prices to buy to close my sold 70 put in this example and sell to close my 68 put on MU. Okay? So I would recommend trying to get filled at the better prices, a limit order if your trigger is hit right now. Okay. All right. Now, if the stock falls within 1% of my short put strike price, and my spread is at a 50% loss. We sort of looked at this last week on that discussion that we posted on the 1% rule and the 50% loss rule. And that concept there, if both of those are hit, if the stock fell within 1%, let's say when the MU was back up at where it was 87, 88, I had sold the 81 and bought the 79 on this graph here, and I got a 30-cent net credit. My true maximum risk on this 2-point bull credit spread is 170. I keep the 30 cents regardless of what happens. But now that the stock's at 81.19, it's within my 1% of, what would it be in this case? 81.80. Just like 70 would be at 81.80 or 80.81. Okay? $80.81. Stock's now at my 1% rule and breached it. It's still out of the money, slightly. But if my liquidation value, the loss if I close the position, is half of the maximum loss of 170, 85 cents, or $1.15 cost to close out of the spread, because I keep that 30 cents regardless of what happens, so I'm really only losing 85, which was half of that maximum loss, then I will exit the position. If both are triggered, absolutely. That's a hard stop for me. I'll get out. On the presentation we did last week, I don't remember the gentleman's name, but he said, what happens if the 1% rule is hit within 3 days of the 10 or 14-day trade? And we looked at it, and the loss was only at about 35 or 40%. If a stock falls and hits my 1% rule for spread management, trigger to potentially close or adjust the position, and in that case, I'm only at a 35% loss, I may decide to roll down the short put strike price. I may decide to just buy to close the short and leave the long put open if I'm expecting the stock to continue down. What is the reason the stock fell? I'd have to do my due diligence on that. I'd have to look into that to see what my expectations are now going forward in that case. I may convert it to a bearish spread by swinging the long option up to a higher strike price. Again, that's discussed in that webinar, the 8 ways to manage a bull put credit spread. But I might not close it, even though I'm at the 1% rule, if I'm not also at a 50% of the maximum loss on the trade. Okay. And I guess I just made 2 slides of the same thing. I apologize for that. But yes, I'll set the alert on the PowerOptions portfolio. I'll see the current liquidation gain and loss. I'll make the decision if I'm at 50% loss of the spread in that case. All right. Now, earlier in this discussion of probability, on the first question we had, I said this is what we've used, the static probability, for the past 5 years with this strategy and this approach. The weekly bull put default search criteria on PowerOptions. The tests for the full years, 2016 was an 84% win rate. 2017 was an 87% win rate. 2018, 83% win rate. And remember, 2018 had 6 months of negative market conditions. That declined from February 5th to 8th of 2018. Remember the China trade war? A month after that, I think it was March 25th through April 5th or something along those lines, there was another decline. And then we had that disastrous October, November, and December at the end of the year. There was also a hiccup in August, I think, after a good run from April to August. But 6 months of negative down market. And if it traded through the whole year, which we probably wouldn't have done, it still was an 83% success rate. 2019, 86% win rate. 2020 was an 89% win rate. This is based on the testing, and we'll talk about that in a moment. So the average was still 85.8%. And the default criteria are looking for positions with an 85% probability or higher. Now, why am I not showing 2021? Well, it's because, I apologize there. It's because, let's see here. It didn't finish yet. I apologize. Okay. All right. Let's see here. I'll have to finish that. Okay, so I'm sorry, I'm not going to be able to show it. It stopped in September. So what I was doing after, I apologize, I got this email from Len, excuse me. After I got this email from Len, is I was running the 2021 full test with the same stops we would use, essentially the 1% rule and the 50% stop on the position. And I was going to show you the win rate there. I saw it get into September, and I think it was still at 89. It doesn't do the win rate until the end, but it looked like about an 88 to 89% win rate so far. It stopped. I apologize for that. It stopped right at September 10th, it looks like. And I'll have to add that. I'll add that on to the end of this presentation here, what those numbers were. Okay, so I apologize for that. Back test went out on me. But I do have to give a disclaimer, and this relates to sort of what Fernando said. Of course, those past results and win rates are no guarantee of future trading performance. An 85% probability by itself does not mean an expected 85% win rate or return. Remember, probability is a theoretical equation, and the higher IV trades are not always the best trades. The results of the backtest I just did just took the top 3 trades that matched on the preferred search day. No other further research and analysis was done, looking at the stock chart, company information, or anything along those lines. The full criteria set includes stock technical and fundamental filters to match the sentiment of the strategy. Just looking for an 85 to 90% probability does not mean you should expect an 85 to 90% win rate. You also have to look for securities that match the sentiment of the trade. That's why I said here that higher IV trades that are showing a higher return with the same 85, 88% probability might not be the best trade, because there's something coming up that might not be related to earnings that could cause the stock to fluctuate and take away from that. Sometimes boring is better. Black swan events and unexpected bad news does happen, as in 2018. Proper position sizing is key for spreads and leverage positions. Fernando commented that probability is something you measure right now. You're absolutely right. What we were looking at for Len's question, he showed me the probability numbers when he sent his email at about 12:15 or 1:15, I believe. I looked at it at 2:30 after I was done a session and putting together another presentation, and as I saw, those were different numbers. Fernando goes on to say each time variables introduced, the probability changes. That's what we saw in just that 1.5 hour period, Fernando. Why he saw the 70 and 68 bull put spread for the 17th of MU. When I ran the search at 2:30, it was the 73.71. And then again at 3 o'clock, I think it was the 71.69. And it changes with the probability that was in that 87, 85% range. Okay. And he says, as an example, if you make an adjustment to the probability change, you can't find the operational information. From my point of view, trade management plus money managements are extremely important. And that's why I mentioned it here as well. You're absolutely right, because the unexpected can happen even with the expected probability that you want that could be very high. Black swan events, February 5th through 8th of 2018. Those other end months, we don't want to talk about it, but we know it's there too. February 26th to March 20th of 2020. We all know what happened in the US markets then. It was happening in other markets before that. We got a little bit of a delay before it really hit the US markets, but we knew it was kind of coming. But it was extreme. And we're still dealing with some of that, aren't we? All right. So thank you, Fernando. You're absolutely right. And that's why I mentioned it.